Welcome back on the podcast. Ernest, how you doing today?
Good.
Yeah, you excited about watching the Stanley Cup Finals tonight? Edmonton Oilers against the Florida Panthers. I don't even know where the Florida Panthers play. Like, where are they based out of? Do you know?
I think is it 31 years, something like that?
What's that?
That Canada.
That Canada hasn't won the Stanley Cup. Yeah, so we'll see what happens.
I think first time in 80 years that a team has come back from down 3-0.
Incredible. Well, we'll see. I'm not really a hockey fan. I'm more of a bandwagon person myself with the Toronto Blue Jays and the Raptors. So obviously the Toronto teams are not doing very well this year, or haven't done well. So I'll jump on any bandwagon I can. I've been to Edmonton, and I live in Canada, so I can say I'm an Edmonton Oilers fan, and I like oil. You got nothing to say. Okay, so we got a packed show today. We're going to talk about our feature discussion will be about the National Bank acquisition of the Canadian Western Bank. But do you want to also talk about the TMX Group?
We could.
Okay. But Ernest went on a visit, a field visit of, we like to do what's called scuttlebutt research, where we actually go out and visit the companies where we can. We're not going to get visits for an Cupertino, Apple's main headquarters. Probably not. They're not going to spend any time with us. But
you can go there and go in the front door.
Sure.
Take a picture.
You went on a site. I think you went on a site visit for an Amazon warehouse once.
Yeah. So we go on site visits once in a while, to the extent that the company is willing to let you go take a look at what they're doing. And the Amazon one is open to the public. You go on their website, you click the link, and they'll give you a tour of the factory, the facility that they have. That was an interesting experience. So last week I went on a tour of a plant for CCL Industries. CCL is a label company that we've talked about before. And I got a chance to go in and see what they're doing.
People really can't comprehend how important labels are until you walk up and down a drugstore or a grocery store. Labels are on every single product, right? And every single product has a different shape or size and different specifications and the type of labels that you want, wraparounds or stickers. So I can imagine that is CCL plant. Is it very complicated or is it very straightforward?
Well, I think the value in doing these kind of plant visits is not so much that you're getting secret information that you can use to invest on.
Yeah.
It's just to get a better sense of how the company operates.
Yeah.
I think a good analogy to this is in the retail industry. You can walk into a store of pretty much any retailer, and you can pretty easily see how the business is being run. Are the employees happy? Are they well trained? Do they have good technology integrated? Are the stores are they neatly designed? And those are the kind of things that maybe help you get a little bit of confidence into the investments that you're making. And so, for a company like CCL, it's not a business that you usually spend a lot of time thinking about on a daily basis.
No.
So you go into their plant, you see that they're making the labels, and I think you get a good sense of what they're doing.
Yeah.
So this specific plant that I visited was in Mississauga. It's located kind of close to the airport and a major logistics hub. And they primarily focus on making labels for drugs, pharmaceutical industry. And that's the way CCL likes to operate their business, is that each of their facilities specifically focus on a specific end market. And this one made drugs for or labels for the drug industry.
Okay. So let's stop right there. So it makes labels for vitamin containers and...
Yeah, a variety of medicines.
So what happens? Does the empty container come get labeled at this plant and then get shipped to be filled with the medication? How does it all work?
Well, this is thrilling stuff, I'm sure. But
I'm interested. So maybe the rest of our listeners are.
So basically, the company, so it might be Johnson & Johnson or Pfizer or GSK, they would send a design to CCL. CCL would print it.
Yeah.
They'll do some and make sure that's the right label. Like there's a bit of technology that goes into that. So it's not just like printing like newspapers. And then they'll send it to the customer, where it's at the customer's plant where they put the label onto the bottle.
Got it.
And for the drug industry, I think what's interesting is that you can't screw it up, because these are very highly regulated businesses about what the label has to look like, what colors are being used, what information has to be on the leaflets. And, like it would be a disaster if you put the wrong label on the wrong medicine.
So the natural question that I have that comes up, maybe it's a dumb question, but I'm going to ask it anyways. Why doesn't Johnson & Johnson have their own label plant for, whatever product that they sell? Why did they have to outsource this to CCL Industries?
Well, to your point, like printing labels is not rocket science. Like it's not something that nobody else in the world can do, right? But then it is sophisticated enough such that you need big equipment. You need to spend money to buy these printers and the equipment. There is like a quick turnaround time to be able to do these.
Yeah.
And I think the important thing is that the labels are generally a very small portion of the cost of the overall product. So like, sure, you might, in the long run, you might save a little bit to be able to do it by yourself, but it's a lot of work that you don't have to do.
And then you're in the manufacturing business, which you don't want to be in.
And I think that's the interesting thing about going on these visits is you don't appreciate how there's like 160 people working at a factory to make labels for the vitamin bottles.
Yeah.
That, like, obviously you see these labels when you're eating vitamins, and you know that kind of at the back of your mind that somebody had to make this label, but it doesn't really hit you that there is a company doing this and making money off it until you actually go there and visit.
So Ernest, we're entering a new age where possibly AI, humanoid robots, more automation. Is this going to benefit a company like CCL or disrupt its business going forward? Has there been any thoughts about? I mean, we're really in early days for that, but
well, they're not really. I think for CCL in particular, the printing labels is not a super labor-intensive business, so it's not. I mean, sure, you might be able to remove a guy or two off the production line, but they're already printing thousands of labels per minute. So to the extent you can automate that even more, it's not really like I don't see that meaningfully changing the profile of the business either way. I do think that large companies like CCL will have the ability to invest faster than other players. So they'll be able to take advantage a little bit sooner than other people.
So finishing off about CCL Industries, it made everybody's waiting for it to make a large acquisition. In the meantime, it made what we think is quite a substantial acquisition in the Middle East that could really push growth.
Yeah, that was a little announcement that they made, I think a week or two ago, where they bought out their labeling plant joint venture in the Middle East. And it's a pretty big operation. I think $12 million in EBITDA for the first 4 months of the year. And
14, I think.
14, yes. Yep. And it's a fast growing market. Like people there are growing into the middle class, and they're buying more food and beverages.
And what people need to understand, of course, that a label in a home country has to be made in its language. There may have to be specific processes or things that they have to say on that label. So CCL needs to build these label plants and manufacturing facilities wherever their customers operate. And labels are a gigantic business, and CCL is a pretty exciting opportunity. If you want to learn more about CCL, we have a podcast called Label Me a Compounder. You can find it, and I think you'll really enjoy. Speaking of CCL, the stock has picked up lately. The company is guiding for what we think are pretty decent results, and if you put some thought into it, it's not hard to see some potentially strong upside for the stock going forward.
It's one of the best performers year to date on the TSX.
Nice, good job. So
that's true for this year, but it hasn't been for a while.
That's true. But the company, I think there was a lot of trends that really hurt its business over the pandemic. We think return to growth as well as some improvements in some of his business lines. It's exciting. So we're excited about this label maker. Speaking of the TSX, Ernest, not a terrible year to date for the TSX. I think with dividends up about 6 or 7% year to date, which is not bad. And
It is an above average year.
exactly. The problem is when you compare it against the Nasdaq, the S&P 500, it's like stuck in the mud. I looked at the 5-year return of the TSX versus the S&P. The S&P is like doubled, the TSX half of that. So it's been a tough slog for those owning the TSX. And essentially, what do you do with the TSX here? So your take.
Well, I think you have to be careful when you're comparing indices like the TSX and the S&P 500 because they're quite different in terms of their composition, in terms of the companies that they have on it. Like S&P 500 is only, for example, is only large caps in the US, and Canada is the TSX pretty much covers most of the country.
Yeah,
because small cap Canada is not really a thing, to be honest.
Yeah, I like the 15th biggest company on the TSX is about $45 billion US. That would make it like a 300th company
Yes.
on the S&P 500, give or take, right? So
exactly. And I think in the US, a large portion of the performance, this has been quite well documented, has been driven by a handful of stocks, namely NVIDIA. And I think NVIDIA is like 30% of the returns year to date.
This year, yes.
So in Canada, you don't have any companies, well, maybe not really, but you don't have anything like Apple or NVIDIA or these kinds of companies that are benefiting from excitement in AI.
Yeah. No, we're not at the moment. I mean, there have been times when specific stocks in the TSX have taken off like a rocket ship, namely Nortel, and no one wants to remember that one. Of course, at one point was 35% of the index. You had times where BlackBerry or Research in Motion, I think, became largest companies. Shopify almost became the largest company. But yeah, completely missing the AI trend.
Yeah, and so if you look at the S&P 500 equal weight index, which tells you the median performance of the companies that are in the index, it's much closer to the TSX. I think it's up like 5% year to date.
Is that so? Okay.
So backing out NVIDIA and Apple and Google and all these kinds of companies, performance much worse in the US. And then you add to the fact that the Canadian economy is just doing worse than the US.
The Canadian economy is doing fine. GDP is positive and employment has been still pretty strong. Everybody is concerned what's going to happen the next 6 to 12 months as these interest rates start to hit the economies. But still, it's doing okay, right? Yeah, and it's the issue really is looking at the components of the index, right? What's under the hood? What's driving the returns? As you mentioned quite clearly, it's the big techs that are really driving the performance, the strong earnings growth. But the question is, okay, so the TSX is underperformed. Naturally, maybe an unsophisticated or even a sophisticated person could say, well, mean reversion, it's eventually going to recover or it's going to outperform at some point. Is that really a meaningful statement without referencing the components and the earnings and power of the individual stocks in the TSX?
No, and I think that's the point is that I don't think people think enough about how index, like the composition of the companies that go into indexes. In the S&P 500, all 500 businesses are pretty good businesses. Like that's how you get into the S&P 500 is that you have to meet certain profitability and market cap requirements. So these are large companies that are profitable.
Yeah.
In most other indexes around the world, including the TSX, that's not really true.
Yeah.
Right? Like there are requirements about how you have to be in there, but the average company on the TSX is much worse than the average company on the S&P 500.
Yeah.
So instead, like I don't think that indexing something like the TSX is a good idea. I think what you should do as an intelligent investor is look for companies that you like in Canada rather than pick the index and just say, when is the TSX going to do well? which it is actually doing all right.
Yeah, it's doing all right. It's just a hard index, and even when trying to pick individual stocks in there, a lot of them are commodity sensitive. A lot of gold stocks, mining not as much, of course, oil and gas, but which can be very frustrating. And there's no guarantee. We like CNQ, we like Tourmaline Oil, well-run oil and gas companies, but Ernest, they're not in control of the price of the product they sell. And you could have many, many years in a row where the prices are depressed, and that's just the way it is. And you will not have good performance. And you don't have to look too far in history. From 2015 to 2020, oil and gas did not do well, right? Oil prices hit a high in 2015 and then plummeted, and you were not happy to hold energy stocks over that period.
Exactly. So we still have a decent weight position in Canadian stocks here.
Yes.
And most of the ones that we own are more international names that are well-run businesses that they're headquartered in Canada, so that's why they happen to be listed here.
Yeah.
But like CCL Industries, for example, these are businesses that we'd own regardless of whether they would trade in the TSX or in the US or somewhere else.
Absolutely, that's a good point. Constellation Software only listed on the TSX. If it was listed only on the US, we would own it.
Exactly.
But we don't want to be in a position where we have to buy something on the TSX because we're spending Canadian dollars. I think that's a big mistake for investors. And I think, we've talked about this for many years. We've been trying to pick the best companies wherever we can find them, and on exchanges where we're comfortable investing in countries we're comfortable investing in, and obviously North America is a place we're happy to be. If there was better businesses in Canada, we would own more businesses in Canada. We always get asked, okay, if the Canadian dollar went up to this or went down to this, would you switch stocks? Your feeling of currency.
Well, I think it makes a little bit of difference in terms of your results, but I think a large portion of this is often offset by the fundamentals of the impact of currency that they have on the business. So to the extent that the Canadian dollar falls, sure, you might get some translation benefits owning US stocks, but then Canadian businesses that have international operations, they would get an FX boost as well.
That's right.
So I think these things impossible to predict, and we often don't really spend a lot of time thinking.
Not really. And I think our thought process right now, Ernest, is we like a number of Canadian names, and there's really not others that we're interested in buying at the moment. And even if interest rates fall or oil prices go up more or gold prices go up, I don't think there's businesses that we're interested in finding. I mean, as a head of research, where are you spending most of your time?
Well, I think we've talked about this before. Most of our time is just spent looking for good businesses.
Yeah.
It's very rare that I look at a stock just because, the stock price fell by 40%. That's just not how we do things, right? Ideally, what you would want is that you studied a business, you thought it's a good business, and that's something that you want to own, but maybe the stock price was not at a price that you thought was attractive. And then if some things happen, maybe stock sells off, like MSCI we talked about last week, and then we find a good entry point, and that's what I spend most of my time doing.
All right, so talking about Canada, we're going to talk about a real Canadian bank here. I think is National Bank dual listed? I don't think. No. So we're going to talk about National Bank, and one of the few banks that we actually own right now across all clients. So some clients own some other bank positions. Maybe they brought them in. Maybe we think it makes sense to have a little bit of diversification. But National Bank is the only Canadian bank that we own of size. Did hit an all-time high a few weeks ago, and then out of the blue announced that it was going to acquire a smaller competitor, the Canadian Western Bank, based in Alberta, and the stock has immediately fallen about 6 or 8% since then. Also, the Canadian stock market in the last few weeks hasn't been doing well so far. In June, the TSX is down. A few more days left. We'll see what happens. So, combination of those two things has really hurt this stock. But I think this is a deal that people thought eventually would come for National Bank. Many people speculated that National would maybe acquire Laurentian Bank, another Quebec-based bank. But there's reasons to think that this deal makes a lot of long-term sense. There may be some short-term pain. Many are commenting that National possibly overpaid in the short term for this acquisition, or talking about that there's going to be some significant regulatory hurdles that it will have to cross. But let's get into it. The National Bank acquisition of Canadian Western Bank. Go ahead, Ernest.
So I think the reason why the stock fell after the deal is less so about negative reactions to the actual investment community's feelings towards the deal, and more due to the fact that they're raising money at a lower price. They're selling a lot of equity to the pension plan.
Yeah.
I don't know how to.
Well, it's an all-stock deal. It's an all-stock deal, and they're selling. It's really weird. It's an all-stock deal. National's acquiring Canadian Western Bank, trading stock for stock, but it has to raise cash to satisfy regulatory capital concerns. And so it sold $1 billion worth of stock, $500 million to the public, $500 million case de depot, which
at a lower price.
At a lower price, which generally, Case Depot generally supports a lot of Quebec-based companies. If you do research, you'll find that it owns a lot of stakes in Quebec-based companies.
And so these shares were issued at a lower price than the current market price, as these things usually go.
Yeah, well, but that's a bargain discount, right? That happens when you buy in bulk. You should get a discount.
And so that's probably why the stock fell.
Okay.
So I can take a step back, and why National has done better than the other big six banks.
Yeah.
Is that I think unlike the other major Canadian banks, National is the most domestic focused bank. They don't do anything in the U.S. apart from a small equipment rental business. They don't really have too many weird experiments in other parts of the world apart from a Cambodian bank.
They have a Cambodian bank, but aside from that, okay.
Apart from and they are mostly focused on Quebec, which is, people like to think of Canada as Canada, but Quebec has different economic fundamentals than the rest of the country. There's less housing risks in Quebec. The household debt is a bit lower.
Yeah.
There's more dual income families, right? So generally, the economic fundamentals are a little bit healthier in Quebec than the rest of Canada.
And we've had, Ernest, a slowdown in Canadian banking. We've had some pain with the rising mortgage rates. I think National is a perfect barometer. They've told the community, the investment community, that their results have really not been hurt as a result of rising interest rates. I mean, no question, consumer slowdown spending will happen if more money has to be directed to your mortgage. But I think they've said that, for the most part, their loans, their mortgages in Quebec have been okay, even with rising rates. Yeah,
exactly. And so they bought Canadian Western Bank, which is a bank it's a smaller bank, but it focuses on Alberta and BC, so largely Western Canada. Canadian Western Bank, unlike the banks that most people are familiar with, they're more focused on commercial. So they don't do mortgages, they don't do credit cards. They are largely taking deposits and lending to small business owners. So I don't know if you own a farm or something.
Yeah.
If you own a farm, then you can open an account at Canadian Western Bank. They'll give you loans to buy real estate, finance your farm, buy your tractor, and all that kind of stuff. Yeah. And so I think the reason why National wanted Canadian Western Bank is that it's really hard to grow organically as a bank in Canada, especially if you're primarily focused in Quebec, right? That National is. If you go out, if National goes out and opens a branch in Alberta, no one knows what National is there. It's not going to do anything.
It's going to take time in other words, it's going to take time to build out its network and its relationships there. Yep. And this is a faster way of doing it.
Yep. And so I think that National thinks that to the extent that you think Alberta in particular has, they've gone through a rough couple of years because of the weak energy markets. Yep. But to the extent that you think Alberta is going to be a healthier economy going forward, I think that's what they're betting on, is that they want a footprint in Alberta. They want to be able to grow in a place that they like. And they're paying 1.17 times book, less now, but like 1.1 times book value for an established branch network that they can go in and immediately have a footprint.
And possibly buying it at a pretty good time. If interest rates are going to start getting cut in Canada, maybe that will spur some more loan growth, some commercial loans, and maybe they'll be able to buy Canadian Western Bank at a good pivoting point, a good time. And of course, could be some synergies, right? National Bank can start offering a number of its products and services that Canadian Western Bank just can't offer its current customers, right?
Right. So one of the things that National has a pretty big business of is their wealth business. They have a big wealth business. Canadian Western Bank doesn't really offer that to most of their customers. That's an opportunity that National will have to add going forward. Another thing is that National has a big capital markets business. So there's maybe some cross-selling opportunities that exist there. And then lastly, I think one thing that some analysts have talked a little bit about is that there is an opportunity for National to reduce the amount of capital that Canadian Western Bank has to hold. So the way banks work is that in order to prevent them from collapsing, they have to hold a certain amount of capital on their books to meet deposits and those kinds of things, and in case loans go bad. This is getting super in the weeds, but
I think you've done a good job explaining it.
And so Canadian Western Bank was stuck using a legacy model that in essence required greater capital requirements.
So maybe National Bank has to hold 10 cents for every dollar it lends out as capital, and Canadian Western Bank, maybe because it's a smaller bank, maybe because it's hasn't done all the proper paperwork, it has to hold 13 cents. And so by combining the two, you could unlock some capital that can be lent out. And banks are in the business, everybody understands, of lending out money. It's a spread business. So the more capital you can lend out, the more money you can make on money, and blah, blah, blah. I mean, it's a good thing if it works out.
And so I think that's an opportunity that National will have at Canadian Western Bank.
So there's a number of exciting things that National could do. Synergies, unlocking capital, cross-selling, figuring out some costs, opening new branches. We all know Alberta is fast growing. Calgary's economy is recovering very nicely. Edmonton, let's go Oilers. There could be some real growth out there. The housing market is certainly a lot cheaper than the cities like Vancouver and Toronto, and Montreal. So there's opportunities for those economies to grow and National to grow with it. And I will give National big credit. They are long-term thinkers, and they have been excellent acquirers in the past. You talked about their wealth management division. They bought pieces from TD Waterhouse. They built out other pieces. First Marathon many years ago. I mean, they've built out a tremendous platform. And so I think it really comes down to a very strong management team that National has. We talked about our concern for the Canadian banks many times here on this podcast, and we've walked the walk. We don't really, unlike other Canadian investors, we have a very small allocation to Canadian banks. I think can't be more than 2 or 3% of our portfolio. But we like National as a good platform, and we think if this deal works out, it could add materially to National's earnings over the long term. In the short term, anybody's guess.
I think that's a kind of a underappreciated aspect of this deal is that National is avoiding all the most, areas that are viewed as the most problematic in the Canadian economy today. They're avoiding the residential mortgages in Ontario, right? They're not doing anything with consumer credit, which is kind of something that people are worried about. They're not doing auto loans, right? They're focusing on Western Canada commercial loans.
It's a very low risk acquisition. Canadian Western Bank, it's not like they're buying a startup bank. Canadian Western Bank is very profitable. It probably in need of new management. Its stock has gone nowhere, I think, since 2010, which is ridiculous. So pretty much all you've gotten is the dividend. I think I think there's some real opportunity for National to grow. One of the knocks on National has always been in the past, Ernest, that it's a regional bank. But boom, all of a sudden now it's trading at a premium valuation, pretty much the same valuation as Royal Bank because of its execution. So over time, what matters is management, execution, earnings growth. National has delivered on all three, and that's why its stock has been the best performing Canadian bank, not going back 5 years, 10 years, but actually going back since 2000, 24 years of outperformance, even better than Royal Bank on a total return. So we're hopeful that will continue. Anything else you want to add?
I think the former CEO wrote a book,
He did.
but it was in French, so I can't read it.
How's your French? Is no good?
I stopped taking it in grade 9.
Oh, I did better than you. I stopped taking it in grade 10, but I'm terrible at languages. You?
I'm really surprised that with all this stuff about AI now, that you still can't translate this book like on Kindle. Like, how is that not a thing?
I would love to read this book. So please, Louis Vachon, please get your publishers to translate into English. You'll at least get two buyers of the book here, and maybe some from the podcast. Just quickly talking about Louis Vachon, one of the longest tenured bank CEOs in Canada. I think he stayed at National Bank for 14 plus years. Terrific track record, right up there with Jamie Dimon in terms of shareholder returns. Written a book. We'd love to read it if it's translated into English, but that's what sets National apart. The new CEO, I can't remember his name, is Laurent Ferrara or something. Hopefully he's been tutored well by Vachon, and we think the Quebec-based company is no longer going to get that Quebec discount. It's really grown into itself, and we're excited to own it for the long term. That's it.
Yep.
We'll see you back here real soon. Thank you so much for joining us.